They got like 8 things I can go with, David, but I really want to go right away to what I see on the Bloomberg. Let's bring it up if we can. And this is the probability of a rate cut out to January, and it's at a Rosenberg level. Why are we going to see a rate cut, oh wise one?
Well, because the economy is going to slow precipitously. I think that recession risks are already elevated. If you go to the New York Fed produces a monthly recession risk barometer. Yeah. It's at an 11-year high, and it's risen every month this year. Even as the stock market's risen to new highs, the recession barometer has actually gone up 6 straight months. So I think recession risks are going to continue to increase. I think that the Fed's view that core inflation is moving back to 2% is going to be as prescient as Janet Yellen's view on transitory 2 years ago. So I think it'll get pushed into a rate cut in the second half of the year.
In the second half, even before this January chart I just showed, Priya Misra at 243 on the 10-year. Gary Schilling and others, Steve Major at HSBC talk up sub 2%. Can we actually get there on a 10-year yield price up that much?
I think if the Fed is actually easing, then you can, because then they're going to take rates down to all the way to 0. They're going to do more QE. They're going to use forward guidance. So I think
this is an important distinction. If he's right, which is rare, but if Rosenberg's right, are you suggesting a linear move from 2 down to 1, down to some form of 0?
I think rates could absolutely fall because I don't really buy this insurance cuts. The idea that the Fed can just cut 1 or 2 times. If they're starting a full-on easing cycle, they're taking rates down to 0. They're using everything in their toolkit. We're talking about average inflation targeting. Then I think they're going to, pull all stops. So essentially, that's going to take rates lower. I will disagree a little bit with David here. I think, financial conditions are very easy. I know the stock market has fallen very recently, but we're still significantly higher than we were end of last year. We've had, growth come in much better than expected. And importantly, China has put a lot of stimulus measures out there. Now, we are seeing the early signs. I think the data last night actually showed that we're seeing early signs of improvement in China. It's still very slowly filtering through into Europe. But the U.S. is growing okay. So for the Fed to start cutting, I'm worried that the market's going to say, what does the Fed know that we don't know? So I don't know if they can be actually preemptive here around cuts. I think if growth is at 0, then absolutely, I think they're starting to ease.
And David, to Priya's point actually on the market, so let's forget the real economy for one side, but does the Fed talk too much? Is there a problem with the Fed actually delivering their messages, given what we've seen in whipsaw in the market over the last couple of weeks?
Well, look, the Fed's message constantly is just a mark-to-market message. Richard Clarida is going to be saying a lot of different things 6 months from now than he's saying today, just as Ben Bernanke was singing a totally different tune in 2008 than he was in 2007 when he was telling everybody that subprime was going to stay contained. So I think we have to stay ahead of the curve here. I disagree that the U.S. economy is in great shape. I think that really it's an incredible how lucrative the market is for looking at headlines and not digging under the hood to actually take a look what's going on. I can't believe how often I hear about the 3.2% real GDP growth in the first quarter. Do people actually look and see that when you add up consumer spending, non-res construction, housing, business spending on plant and equipment, like the domestic guts of the economy, actually was barely 1% at an annual rate. It was stall speed. Then people just go to the non-farm payroll survey as if that's the only employment number that's out there. And never mind that a quarter of the job growth in that particular survey is from the birth-death model. The household survey, actually, which nobody talks about, does a much better job at inflection points of the cycle than payrolls do. Well, let me just finish here. That household employment, and nobody knows this number, was down to 103,000 last month. So I actually tell you, the U.S. economy is weakening more than people think. The stock market, it's almost impossible to know what's driving the stock market. But what I know historically, after doing this for 35 years, is that the bond market historically gets the story right before the stock market does. And the fact that we have the 10-year note yield trading below the top end of the Fed funds target is, I think, a pretty clear signal that the bond market's telling you things are going to be cooling off here substantially at a time when core inflation is already below target. That's the rationale for the Fed to be adjusting the funds rate lower later this year.
Right, but so Dave, does it mean that you basically ignore any kind of communication from the Fed? I mean, if the Fed tells you, look, we could either cut or hike, what does that actually tell you about what they're looking at? You're telling me that you're seeing a weaker economy than expected.
Look, back in January of 2001, Alan Greenspan was telling you that all we had in our hands was an inventory correction. Meanwhile, 3 months later, we understand that actually we have a deflationary detonation of the capital stock. So frankly, as a private sector economist, if I actually paid attention to what the Fed is telling me as they mark to market their views to only change them 3 months from now, no, I have made a career doing that. So in the last cycle, you'd be asking me in 2006, well, Ben Bernanke says that house prices never decline nationwide, not to worry about it, and that the problems in subprime are going to stay contained, which goes up there with, Chamberlain's Peace in Our Time. So what I'm saying right now is that what I'm predicting is this. I'm predicting that the Fed's message is going to be a lot different 3 to 6 months from now than it is today, because all they do is they tell you about what's happening right now. Well, we're in a good place, we're told by Richard Clarida, but are we going to be in a good place 3 to 6 months from now? I don't think so.